Hello and assalamu alaikum everyone. I'm Kashif Kamran, AAA expert tutor with the question 2 of the AAA December 25 mock debrief. Now already I have had two sessions on this December 25 AAA mock. The first being an overview session where I shared the feedback of the students in terms of the weaknesses identified from the 207 mocks evaluated. And in the session two, I went into the question number one, which was around the Carrigan company. Now, today in the session three, I'm looking into the question number two, again, emphasizing the area which was done weak by the student. Let's open up the question number two and identify what was basically the requirement. Now, when you look at the question two in front of your screen on the ACCA practice platform from the pre-December 25 mock, the question number two, you open up the requirements, and the first requirement is recommend the matters to be included in your report to those charged with governance and explain the reason for inclusion. This is not the first time you're looking at this question. So many times in the past paper, if you have done the recent past papers from September 2022 to June 2025, you must have got this question at least two times in the past paper. So why the matter will be included in your report to TCWG and what's the reason of the inclusion? We have 13 marks for that. So you will simply copy paste this requirement and you will bring this to your word processor where you need to answer this. And on your word processor, you paste this requirement. We'll see how many matters are given to us in the exhibit one, because you have to answer this question using the exhibit number one. So from the exhibit number one, we'll see the number of matters and then decide how to split the 13 marks. Using the exhibit two, that's the B requirement. So you have to use the B second exhibit. Evaluate the matters to be discussed with management in relation to the legal claim. So what matters will you be discussing with management in relation to the legal claim, and justify an appropriate audit opinion explaining the impact on the audit report if the misstatement remain uncorrected. So if the misstatement remain uncorrected, what will be the appropriate audit opinion? Will you issue a qualified opinion or an adverse opinion? Now, you have to be clever. And that was the problem I faced with students when I was evaluating the 207 mocks, that when the examiner is telling you that the misstatement remain uncorrected. Now, if the misstatement remain uncorrected, either the uncorrected misstatement is immaterial, then that is an unqualified opinion, or the misstatement remain uncorrected is material, then you have a qualified opinion, or the misstatement remain uncorrected is material and pervasive, you have an adverse opinion. Now, if anyone is thinking about a disclaimer, you're absolutely wrong, because we're talking about a misstatement. Right? Now, if anyone is thinking about an emphasis of a meta paragraph, that is wrong, because we're talking about a misstatement. A misstatement remain uncorrected. And for that, you need to justify an appropriate audit opinion. So what will be the opinion? If it is a material one, then a qualified opinion. A pervasive one, adverse opinion. Or an immaterial one, an unqualified opinion. So evaluate the matters you should be discussing with the management in relation to the legal claim, justify the opinion and the impact on the report if the misstatement remained uncorrected. We have 7 marks for this. And this was the most worst part which I've seen in the mock. And the problem is that the student don't read the requirement carefully, and they try bringing the CAM, MURGC, emphasis of a meta paragraph, everything in 7 marks. I've seen students writing MURGC. I've seen students writing emphasis of a meta paragraph. I've seen students writing a CAM. I don't know why you fail to read the requirement which says misstatement remain uncorrected. So if the misstatement remain uncorrected, I can only have 3 branches: immaterial, material, pervasive. So either it's unqualified, it's qualified, or adverse. I need to see the exhibit number 2 to judge which is the best one. But if you're thinking about emphasis, MURGC, CAM, I don't know where are you going in terms of your audit report knowledge. So we had 7 marks here. So you bring it back to your word processor and we'll see a proper scan of things. Okay, you paste the requirement here for 7 marks. And you close your exhibit. which was about the requirements. And let's now quickly see the overview here. It is the 1st of July. You are a manager at Crypto, a firm of chartered certified accountant. You have recently been assigned to the audit of Luthor Company, a listed company. So remember that Luthor in the exhibit number 1 is the listed company. So be very important. And the audit client of your firm for the last 10 years. So it has been a client for our firm for last 10 years. So we know a lot about him. In its financial year is 31st of March. So the financial year for Luthor is 31st of March. And the main business activities is to manufacture the farm machinery. You are also assigned to the audit of Clark Company. So that's the exhibit number 2 for the year ending 31st of May. The audit of Clark is nearly complete and the audit report is to be issued next week. So you are about to sign the audit report next week, and we have a problem with legal claim. So we have to think the implication of the legal claim on the audit opinion. And for the Luthor Company, it's a listed company. We have been doing audit for the last 10 years, and that is it. And I am a manager. Now, with that, you come down here and start looking at the first requirement. Now, the first requirement says, recommend the matters to be included in the report to TCWG and explain the reason. Now, every matter you will include and you tell why it should be included. You will be getting 1 mark for every valid comment, and you have to take your number of points to 13. Now, you open Luthor Company. I will not be solving this part because this was excellently done by all. In Luthor Company, how many matters we have? Inventory is the first matter. Warranty provision is the second matter. Availability of information and manual journal is the third matter. Engagement partner is the fourth matter. And procurement procedure is the fifth matter. So for every matter, you have to tell why this matter will be included in the report to TCWG and the reason of the inclusion. And the number of points you develop must go up to 13. So how many headings will you have for the 13 marks answer? 5. The first heading you will have definitely is inventory. Number 1. I'll just show you one example, though my purpose is just to focus on reporting. Inventory will be the first heading. Then warranty provision will be the second heading. Then the third heading will be availability of information and manual journals. Then the fourth heading would be engagement partner. And the fifth heading would be the procurement procedures. Now you will put the headings because segregating the answer in headings makes the life of the marker easier because he or she can easily check in that you have focused on every matter given in the exhibit number 1. Okay, now just give you an example how you go about it. Now definitely at the start of the exhibit, you have been given the revenue number, $247 million. You have been given the profit number, $14.6 million, and you have been given the total asset numbers at $535 million because you might be needed to determine the materiality, is it material or not, and to comment on that, the numbers have been given to you. It's not like the question number 1, where the partner tells us that you have to determine the materiality on a factor, and that factor is given in the email, and you determine the materiality on the profit before income tax. That was the question number 1 we did in the session 2. It's the second way where we have been given the numbers, and if we find any problem, we'll divide them by revenue, profit, and total asset just to see is it material or not. The audit partner has asked you to review a file note prepared by the supervisor and to consider the matters to be reported to those charged with governance, right? So you are a manager, you have to review the note from the supervisor, and let's see how each matter will be communicated and why. The first matter is inventory. The company draft financial statement for 20X5 includes inventory balance of $150 million. So the amount of inventory we have in the balance sheet is $150 million. The company has chosen to adopt a policy of valuing its inventory using the first in, first out basis for the first time. So they're changing the method of valuation of inventory for the first time to first in, first out. Now, anything which is done for the first time, it's something important and it should be brought to the attention of TCWG. So first time is an important thing here. And this reflects in the draft figure of 20X5. The audit working paper identifies that a review of the inventory record four inventories categories with a total carrying amount of 7 million has not yet been remeasured and remain recorded on the prior weighted average cost basis. So out of the $150 million, which is in the balance sheet, there are four inventory categories of worth $7 million, which has not yet been measured at FIFO, rather than being used at the older basis, weighted average cost basis. Now that's the problem which you need to communicate to TCWG. So you control C and you bring it down to your inventory and you copy paste here. Now, very first thing the manager has to do is to see whether the $7 million, which relates to the four inventories, is it material or not. So you will first comment on the materiality that four inventories categories with a total carrying amount of $7 million has not yet been measured and remain recorded on the prior weighted average cost basis, full stop. This $7 million is, you find the percentage, you go to, because 7 million is a part of inventory. So inventory affects the P&L, inventory affects the balance sheet. So we can take it on the basis of the profit before income taxes for the P&L, and we can take it on the total assets for the balance sheet, right? So you take out your calculators, use your calculators to find out how much is it. $7 million divided by your profit first. Your profit is $14.6 million. So you divide that by your profit, 14.6, and it's okay. So you take out your calculators and you find out how much $7 million is to the 14.6 million. So it's like 48%, 47.9%, right? So it's 47.9% of the 47.9% of the PBIT, profit before income tax. Please use the right terminologies as per IFRS 18, not the profit before tax, the profit before income taxes. And let's see how much is it of the total assets. Of the total assets, it's 7 million divided by, we have the total assets at 535 million. So definitely the percentage will go down. 535 into 100. So that's 1.30%, and 1.30% of the total assets. Now we know for total assets, 1 to 2% is material, and for the profit, 5 to 10% is material. So in both cases, it is material. So of the total assets, thus it is material to both the income statement and the balance sheet. It's material to the financial statement. Simple as that. So you got your first mark because you determine the materiality. So everything is worth 1 mark. So the moment you determine the materiality, straight away you get 1 mark. Then you say, what's the problem? The management has not recognized or has not remeasured the $7 million worth of inventory at FIFO basis, which results in a material misstatement in the financial statements, which result in material misstatement in the financial statement, and the inventory and the cost of sales could be, we're not sure, could be under or overstated. Could be under or overstated. So you're telling management another 1 mark. Then in the next paragraph, when management, 1 mark, when management changed the policy to value inventory on FIFO basis, it should apply to all categories of inventory. So leaving four of them at the weighted average cost basis is not acceptable. Another one mark. Thus, because it's a material misstatement, which needs to be rectified so that the financial statement gives a true and fair view. This matter should be brought to the attention of TCWG. Last mark. See, I've got 4 marks minimum from inventory. First for materiality, then for the misstatement what is the misstatement, then for that when you change a policy, you should apply it for the whole class. And then finally, because it's a material misstatement and you need it to be rectified and you need to bring this to the attention of TCWG, only then they will rectify. So 4 paragraphs under inventory, and every para is a point and every point is a 1 mark. So 9 marks remaining, and you have 4 headings. So in some headings, you might be writing 2, under some 3, under some even 1. But in the remaining 4 headings, you have to take 9 marks. So that's what you need to do. So you will read warranty provision, availability of information, engagement partner, procurement procedure, and keep building up your answer just the way I wrote for inventory. In every situation, something could be different. It's not just about materiality. It could be something of a management bias. It could be something that management is doing a window dressing. It could be something ethics like engagement partner. There could be some ethical dilemma. We even bring the ethical dilemmas to the attention of TCWG. So even that has to be communicated. So everything has to be communicated, but the logical grounds has to be decided by you why it should be included. Now, this part was done fairly good. Almost the average scoring I have given to students of 13 was 9 or 10, 9 or 10, because this was done excellently well. The problem come with the second part. Now, in the second part, which is the B requirement on your screen now, in this requirement, we have to evaluate the matter to be discussed with management in relation to the legal claim. So the problem is with the legal claim. So we have to emphasize on the legal claim only. Legal claim. And for the legal claim, we need to see what will be the opinion for the legal claim and the impact on the audit report. So for the legal claim, what we need to discuss? For the legal claim, we need to discuss matters to be discussed with management. So what matters will you be discussing with management for the legal claim, and what will be the opinion and the impact on the report? Let's open up the exhibit, which is about Clark. Now, please ensure you have to keep your focus on legal claim. You're not focusing on anything else. If you deviate from the legal claim, you are not you're not being appreciated by the examining team. Okay, just let's see what is happening here. Clark Company is an unlisted company. So the moment you think about it's an unlisted company, I don't know from where student brought a CAM. It's an unlisted company, and we know that in a reporting question, every time the examining team will tell you either it's listed or it's non-listed. It will be very particular. A family-owned business which specializes in the service and repair of both commercial and privately owned motor vehicles. The draft financial statement recognized a profit before income tax of a $4 million and a total assets of a $41 million. Now that's been given to us in a reporting question to again comment on the materiality, that whether the misstatement is material, immaterial, or pervasive. So we'll use these numbers when we need. So the profit is 4.4 million and the total asset is 41 million. So we'll just copy paste it here on our word processor. So when we need to comment on the materiality, we can easily comment on the materiality. Okay. In March 20X5, Clark Company was found liable for an environmental contamination at a former workshop site. after the hazardous chemical leaked into the groundwater. The Environmental Protection Agency issued a cleanup order requiring Clark Company to pay $1 million. So how much Clark Company needs to pay? $1 million for the remediation work. So that is the legal claim, right? $1 million, which remains unpaid on the 31st of May. We have not yet paid it. So we need to recognize a liability because we have a reliable estimate. We have an obligation arising from a past event. A reliable estimate can be made, and we have a probable outflow because we already got a letter from the agency that we have to pay a $1 million. But it is not yet paid on 31st, but we need to record a provision on 31st. The audit working paper include a copy of the verified letter dated 25th May, that's 6 days before the year end, from an insurance company, confirming that the environmental liability claim is fully covered under the company's insurance policy on the basis that the company has no net liability as a result of the environmental claim. The finance director has not recognized any amount in the financial statement and has not made any disclosure. Has no net liability, and the finance director has not recognized any amount in the financial statement nor has given any disclosure. Control C, and we bring it down to our legal claim, Control V, and we've just put this off. Okay, now first of all, we have a legal claim of $1 million, which is to be paid but has not yet been paid. We have a probable outflow. We have a reliable estimate. We have a obligation arising from a past event. So all the criteria of recognizing a provision is met. But what is the director saying? Because the claim from the insurance company 6 days before the year end, it's virtually certain. And he says that as no net liability, there is no net liability, right? Because we're getting the claim. On one side, we have a liability. On one side, we have a claim. So net off. But we know we cannot net off this, right? We have to show the claim separately. If it is virtually certain as a contingent asset or as another income, and we need to recognize the provision. So we cannot just net off both. So if the claim is virtually certain from the insurance company, recognize it as a contingent asset and also as another income. And for the provision, recognize the provision as a liability and as an operating expense, but you cannot net off them. So the view of the finance director is very illogical, and he might be using it as a technique to window dress the financial statement because he's not recognizing a provision because he says because as no net liability. You cannot net off. You cannot net off the insurance claim with the liability. You need to follow the prudence concept. And the finance director has not recognized any amount in the financial statement. So that means no provision is recognized. Even you have not even recognized a contingent asset. You have not even recognized the other income and has not made any disclosure relating to the matter. Obviously, the disclosure being the breach. If you want to give a disclosure of that, you have to give it. But that has not even been made. But we need to focus on what? Impact on the audit report if the misstatement remain uncorrected. What is the misstatement here? $1 million, which is not recognized. So if we just focus on the legal claim, not on the insurance side, and we just argue that the insurance, even though you have a virtual certain insurance claim, you cannot net off. So you need to recognize the provision for a legal claim. Now see how I go by it. Legal claim. Clark Company needs to pay $1 million. Control C, I bring it up here, Control V, which is you divide 1 by $4 million, which is 25% of the profit before income tax. And if you take it by the total assets, 1 million of the total assets, it's 2.43%. It's 2.43% of the total assets, thus material to the financial statements. You got your first mark for materiality as a matter. That's the first matter you're communicating. Number 2, accounting treatment. The claim from the claim was coming from whom? The claim was coming from an environmental protection agency. So the claim from environmental protection agency of $1 million uh, has a reliable, meets the criteria, meets the criteria of a provision, as there is an obligation arising from a past event, a reliable estimate can be made, which is $1 million, and a probable outflow. You have to pay it, a probable outflow. So for that reason, a provision needs to be recognized. So the claim meets the criteria of a provision as there is an obligation arising from the past event. You can quote the past event. That's the leak of the chemical, right, into the groundwater. Control C, and you bring it down here. Arising from a past event, bracket open and bracket close. A reliable estimate can be made, which itself is $1 million. You link the conditions of the ICE 37 and a probable outflow because you have to pay it, uh, requiring Clark to pay $1 million, right? So the agency wants you to pay. Thus, a provision needs to be recognized. Thus, a provision needs to be recognized. Now, they have not yet recognized anything. As the provision is not recognized, as the provision is not recognized because the finance director believes that the insurance claim and the provision will be net off, and thus nothing needs to be recorded, is wrong, as this can't be net off. Rather, the provision should be recognized in the financial statement. And even for the insurance claim, if you want to stretch further, I'm just keeping my focus on the legal claim. I'm not going to the insurance claim. You need to record a contingent asset. You need to recognize a contingent asset and also ensure that you have a other income. If you want to go there, I'm just keeping myself to the legal claim. Rather, the provision should be recognized in the financial statements. Thus, at present, the liability and operating expenses are both understated. The liability is understated, the operating expenses understated, and the profit before income tax and the PBIT is overstated. Now, this is quite possible if you want to score more. We've already got 1 mark for materiality, 1 mark for writing the accounting treatment, 1 mark for writing what is under and what is overstated. And you can take a further 1 mark by saying the view of the finance director uh, could be an additional risk, of management bias. Why is he saying that we should net off and we have nothing to record? The view of the finance director could be an additional risk of management bias, as this net off could be used as a way to uh, window dress the financial statements and show overstated profit before income tax for Clark Company. So the finance director has a motive, right? He wants to fabricate the financial statement of the Clark Company. The way to fabricate the financial statement, I think that would be more professional word, fabricate the financial statement. Now, you're getting your skepticism marks here. skepticism skill. You thought that why is the finance director saying net off? Because he wants to do the creative accounting. He wants to do the fabrication. So you wrote an extra point linking it with the management bias. Where possible, you need to write about management bias in the paper where you think there is something being stated which converts to a creative accounting. Now, that's the legal matter. I'm not stretching to the insurance claim. Now, this is material. It's not been recognized. So, what's the opinion? Qualified opinion, as simple as that. It's a material misstatement. So, everyone is sure that a material misstatement gives rise to a qualified opinion. So, what will you do? What's the impact on the opinion? You start it because the provision which is not recognized, which is not recognized, the provision which is not recognized is material to the financial statements, is material to the financial statements. The auditor will issue a qualified opinion on the financial statements for Clark Company. 1 mark. It says opinion and the impact on report. Next paragraph, the qualified opinion para will be followed by a basis of qualified opinion, basis for qualified opinion para, where the auditor will mention the basis for giving a qualified opinion and explaining that the legal claim and explaining that the provision for legal claim was not recognized. So you will tell it's not recognized and is material. Finally, because of the qualified opinion, the audit report will be modified. So you will have a modified report. Impact on the report. What's the impact on the report? The report will be modified because you have issued a qualified opinion. So how simple was that? It's a material misstatement, a legal claim, even though meeting the definition of ICE 37 is not recognized. It's material. Management could have used it to fabricate the financial statement. We didn't talk about insurance claim, but we talked about that it should not be net off with insurance claim. You can show insurance claim as a contingent asset and other income. You can talk about that, but I've just kept focus on legal claim. And because it's material, auditor should issue a qualified opinion 1 mark, basis of opinion 1 mark, and the audit report will be modified 1 mark. Now see how I put 7 paragraphs for 7 marks. Look at my answer. Look at the 7 paragraphs on your screen. 1, 2, 3, 4, 5, 6, 7. All 7 paragraphs on your screen. Now, what was so difficult? Where was the emphasis? Where was the adverse opinion? Where was the key audit matter? Where was the material uncertainty relating to going concern? We were talking about a provision not recognized and maximum an insurance claim not presented as a contingent asset and another income. But I focused on legal claim only. 7 paragraphs worth 7 marks. Some paragraphs are just like one sentence, like materiality. Accounting treatment is a big, broader paragraph. Then again, the additional risk of a management bias is a shorter paragraph, and some are big, some are small. You go back to the requirements. See over here, professional skepticism. I did exercise my professional skepticism by saying that why is the finance director netting off? Is he trying to fabricate the financial statement? I'm getting my marks. I did analysis and evaluation. I did the calculations of materiality. I exercised my judgment. It's material, it's not pervasive. So I exercise, it's a qualified opinion. It's not an adverse opinion. So my judgment was exercised, so on and so forth. So this is how you go down. The problem with students is either they don't read the requirement well, they don't break the marks well. Just like in the first requirement, we have to break it under 5 headings. And under every heading, we start writing points. And the maximum points we need to write is 13 under 5 headings. Then we go to the second part. It was very clearly mentioned, uh, misstatement remain uncorrected. So we are talking about an uncorrected misstatement. Which misstatement? A legal claim. We didn't went to the insurance. We kept our focus on legal claim. We drafted the answer and we came all down with the impact on the opinion and the report. Now that's it. I hope you do your best in your exams for December 25, which is on the 1st of December, by following the techniques you're learning through this mock debrief, irrespective if you have done the mock or not. Now, that is it. The session three of four, the fourth and the final session is on the question number three, where I'll be speaking more broadly of the due diligence part, which was done very badly. Now, just before I leave you, just a quick glance at the student mistakes they did in the mock exams. Now, see, a student over here wrote, if you can see here, the student here wrote, if the misstatement remained uncorrected, this would result in an unqualified opinion. How funny is that? If the misstatement remain uncorrected, for an uncorrected misstatement, you are saying an unqualified opinion. And over here, you are saying it's material. Material. And over here, you are saying unqualified. How interesting is that? I don't know what happens to student. This would result in a modified report. And for an unqualified opinion, the student is saying it will result in a modified report. No, nothing is correlated here. It says material, right? It says material, then it says unqualified, so they are not correlated. Then you say unqualified and you say a modified report. See the blunder. The next one. Uh, yeah, see, a qualified opinion will be given by clerk if the management do not make the changes to recognize the provision. This will lead to an emphasis of a meta paragraph in which the material misstatement will be emphasized and therefore a modified audit report. A qualified opinion will be given, but the reason of the qualified opinion will be given in the emphasis of a meta paragraph. The reason of a qualified opinion is given in an emphasis of a meta paragraph, or it's given in the basis of opinion paragraph. Then you say why we failed the AAA paper. You fail because of all such things that you even don't know what you're writing. A qualified opinion and the basis of qualified opinion is given in the emphasis of a meta paragraph. Interesting. Okay, again, see, the auditor opinion should include wordings like except for, so at least the student reached the qualified opinion. And if the clerk does not include a disclosure, interesting, does not include a disclosure, emphasis of a meta paragraph will be given, or even the other meta paragraph. If the disclosure is not given, is it a misstatement? If a disclosure is not given, it is a misstatement. So for a misstatement, how can you give an emphasis of a meta paragraph? We give emphasis of a meta paragraph for a disclosure given. But for a misstatement, we give a qualified opinion or an adverse opinion, depending upon the severity. But a misstatement, but a disclosure not given results in an emphasis. You can see how funny these three situations were, which I've shown you. These are overthinkings by student. They try to dump everything. I don't know why. So then definitely you have to fail at the end of the day. So I hope these learnings will go a long way, impacting positively your exams coming up on the 1st of December. I'll be back with my fourth and the final session of this mock debrief for the December 25 exams.